Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the Thursday, the 4th of July, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast. Give me a minute, sorry about that. I hope that my screen, you guys able to see my screen. So far, so good. All right. Okay, any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term intraday technical outlook for today on the major US dollar pair, the major stock indices, and the two key commodities market, i.e. XAU/USD, that's gold, and as well West Texas crude oil, let's have a recap what has taken shape yesterday in terms of the release of key events, key economic data, and as well as the respective price action of the major cross asset classes. Okay, let us start with the key data releases first. All right. So in terms of the key data releases first, yesterday we do have the release of the Fed meeting, which I do highlight earlier in my yesterday's Daily Dose of Market Insights. There shouldn't be any key big surprise of the Fed minutes because it's almost showing the same mantra or the same we call it stances due to the series of Fed public speeches, that means Fed officials public speeches that was released 2 weeks ago, saying that so the Fed minute is actually the discussion between the Federal Reserve officials while they set the monetary policy in the previous meeting in the month of June. So what they actually highlight over here is that they still sees I would say, more evidence of cooling inflation before starting to actually cut interest rates. And some of them starts to sound the alarm bell, saying that further cooling in demand due to the current state of higher inflation, a higher interest rate environment in the US may stoke unemployment, which is pretty much evidence when the release of yesterday's ADP employment data in the US. So what is this ADP employment data? So let me share with you all over here. Okay, where was this data? Yeah, this is the one. Okay, let me highlight put it in bigger font so you guys see. Okay, so this is the one okay, over here, this ADP employment change. So this is considered one of key job data metrics in the US that market participants tends to monitor as well. So it's being compiled by the private sector the company called ADP. So they actually compile this monthly employment change. So they tend to release 2 days ahead of the official non-farm payroll data that is due tomorrow. Okay, so this ADP employment change data has been showing signs of softness. That means the number of jobs added on a monthly basis in the US has started to slow down. So what you could see over here is that the consensus is actually expecting 160K jobs added for the month of June. But what it came in over here, it came down 10K lower at 150K, pardon me. And if you look at the trend of this ADP employment change over here, it's showing signs of growth slowdown. That means the number of jobs added per month is decreasing every month since March. So that actually also linked together in sync with what the Federal Reserve minutes shows. Status one saying that some of the officials are alert of this cooling in demand caused by a higher interest rate environment in the US that may leave unemployment, and it's pretty much evidence and it starts to show on the latest ADP employment change trend, which came in yesterday's June data. The latest one at 150k jobs added came in below expectation of 160k, and it's clearly showing a trend of a growth slowdown in the job market in the US since March. All right, by looking at this ADP employment change job market metrics, and also another signs about cooling demand that is being expressed by the US Federal Reserve officials, some of them but not all of them, is looking at how the services sector perform in the US. Why services sector? Why not manufacturing? Because the services sector in US contribute close to 3/4 of US economic growth, which is much more important than the manufacturing sector, which only form a small portion of US economic growth in terms of its contribution. So yesterday I also do highlight there's an important data to watch, which is the ISM services PMI. So this ISM services PMI is considered as a leading economic indicator to gauge the health of the services sector in the US. Why leading? Because it's based on a survey result being actually blasted out by ISM Institute to the various managers or the purchasing managers in the services industry in the US. All right. So if you look at the ISM services PMI, what we could see over is that yesterday's data came in rather shocking because it came in a contractionary mode. That means for ISM PMI, for any data related to PMI, any data that is below 50, that means we are talking about a state of a contraction rather than expansion, because market is only expecting the data to actually expand. That means the services sector in the US going to expand a bit at a slightly slower rate of 52.5 versus 53.8 that was recorded in the previous month of May. But it came in below expectation, way below expectation at 48.8. So if you look at the trend of the ISM services PMI over here, okay, so if you look at the 5-year trend, okay, so the ISM CPI tumbled to 48.8 in June. So that is the sharpest contraction since almost 4 years, since April 2020. And if you look at the trend over here, it's clearly showing signs of deceleration. That means, i.e., growth not even slow down, but it starts to actually slip into a contractionary mode in terms of the services activity in the US, as inferred by the latest data out from the ISM services PMI. So net overall, it actually tells us that there is leading signs that the US economy is now succumbing to growth contraction, not even slow down, due to a higher interest rate environment. Okay, 1 minute. It seems to me that somebody couldn't hear my data is not showing or something like that. Mic test 1 2 3. Okay, give me a minute. Okay, let me show my screen so that you guys could see. Okay, I hope that my screen now is flashing correctly. All right. So I hope that everyone could hear my voice. All right. Test 1 2 3. Mic test 1 2 3. Test 1 2 3. Okay, so just a quick adjust my screen now, so that, okay, where was I? So previously I'm talking about the ISM services PMI. So yesterday data, it came in at 48.8, way below market expecting, which is market is expecting at this 50. Okay, 1 second. Okay, so market is actually expecting 52.5. All right, and also yesterday's ISM number that came in at 58.8 is the lowest reading since April 2020. So that actually showing signs that the US economy is slowing down. Why? Because the services sector form 3/4 of the US economic growth. So this actually linked to the alarm bells that some of the US Federal Reserve officials has been being on the high side of the alert, as being shown in the Federal Reserve minutes yesterday. All right, where survey warned further cooling in demand could lead to a further rise in unemployment. So these two alarm bells has more or less been supported by the latest data out from the US ADP employment change that is also showing the US job market is showing signs of softness based on the number of jobs added in the month of June, 150,000, which is way below expectation of 160K, and this 150K is showing signs of slowdown. That means there's clearly signs of a slowdown since March this year. That means lesser and lesser jobs added on a monthly basis in terms of the US job market, according to this ADP employment change metrics. So slowdown in unemployment, a slowdown in the employment market in US, slowdown in the services growth in the US, all this net right will start to actually increase the chances of a more supportive voices in the Fed to support interest rate cut coming soon to the US economy. So based on that, if you look at the CME Fed Watch 2, all right, so based on the CME Fed Watch 2 yesterday, the market is still betting, that means the Fed Fund futures market is still betting the first interest rate cut, a very high odds to come in the month of September, 18th of September. Currently, the Fed funds rate is at 5.25% and 5.5%. Is expecting a 25 basis point cut. That means there's high bets or high odds of it, 78% chance for the Fed to actually cut interest rates in the September FOMC meeting, being supported by two key weak economic indicator in the US, the ISM services number, which I flashed to you earlier on, and a slowdown in hiring as being inferred by the ADP employment change data, which I flashed out earlier as well. And what we could see over here is, interestingly, not even the first cut to occur in September meeting, at a high chance of 78%. After that, we stand pat in the month of November due to the US presidential election, as the Federal Reserve will try to be independent of not swaying to any of the Democrats or the Republicans' demands. And right after the US election is over in December, market starts to price in a higher odds of another 25 basis point cut to bring the Fed fund rates down to 7.75% to 5% with the 88% chance excuse me, with 88% chance of cutting. Odds is rather high. Why? Because yesterday only shows 70 plus odds, so there's actually a 10% point increase based on the latest weaker than expected economic data that's out from the ISM services PMI, and as well as the US ADP employment change. And one more data before I jump into the fundamentals and the intermarket dynamics I will share with you all is, within the subcomponent of the ISM services PMI, we do have the ISM services prices paid. So this is considered as a cost of business in the services sector in the US. Okay, so the services prices paid has been inching downwards as well, all right, in the last 3 months or so. Okay, so the services prices paid fell for the second month to 56.3 in June, down from 58.1 in May. So in the past 3 months since April, May, June, it has been cooling off, all right, in terms of the prices paid. So prices paid cooling off, it implies that the services sector cost of business or input cost is also slowing down as well, okay, rather than picking up. Okay, so net overall, what it implies over here is that it also supports the mandate of, or the mantra of, the US Federal Reserve to start thinking about cutting interest rates in the US, right? So that actually overall, now back to the back to the intermarket dynamics right now, share with you, that actually reduces the US 10-year Treasury yield. Okay, so if you look at the US 10-year Treasury yield, it actually grew softer yesterday by 2 consecutive days of decline by these 2 bearish candlesticks you could see over here, right at the key medium-term resistance of 4.5%. Okay, a reduction over here. So with the 10-year US Treasury yield slowing down below 4.5%, and on the 2-year as well, the shorter term 2-year treasury yield, that also refused to actually break above the 20-day moving average by showing 2 consecutive days of downtick as well, way below the key medium-term resistance at 4.84%. So that actually indicates to us that the longer-term cost of funding and the shorter-term cost of funding picture in the US is not picking up. Number one, at the end of the day, it's actually encouraging for the US stock market. So right now, the thing about US stock market over here is that, do not forget, stock market is always forward leading. So any signs of data that is getting weaker, strangely, it leads to a better performance of the US stock market. Why? Because cost of funding will start to come down, which relates to lower discounting rate, potentially higher profit margin at this point in time, unless we start to show a further deceleration in the US ISM number, then the stock market will start to panic that we could start to be in a recessionary mode rather than a Goldilocks scenario. So in the short to medium term, it's still supportive of the US stock market, which eventually see a very strong performance intraday on the S&P 500. So on the S&P 500, yes, it started off in a sideways footing at the start of the US session, and right after 9, I will call it close to the 11 p.m. mark in Singapore time, the market rallied all the way very strong and very on a firm basis, and closed much higher to a fresh intraday high. It's fresh all-time high as well, and very similar on the Nasdaq 100 as well. Strong push up for a fresh all-time high yesterday as well. And one thing that is lagging behind is the Dow Jones Industrial Average, traded sideways throughout the US session and almost unchanged at negative 0.6%. The Russell 2000 also benefited from a lower cost of funding environment, especially on the long-term basis, given that most of the Russell 2000 companies are actually companies that has a weaker balance sheet, that means i.e. a higher debt burden, but unfortunately a lower net profit margin, but that could actually benefit from a lower cost of funding. So that should explain why the Russell 2000 managed to inch up again, intraday gain of 0.14%. So net overall, what we could see, yesterday's strong performance in the US stock market is still being led by the mega cap stocks over here, the tech mega cap stocks. Okay, let me highlight to you all. All right, over here. So what we could see over here is that Nvidia is leading the fort yesterday, plus 4.57%. Which is very important. Why? Because it's the second biggest component stock both on the Nasdaq 100 and as well as the S&P 500. And what we could see over here is that the rest of the other mega cap stocks also perform rather positive as well, more positive than negative. You see Microsoft and Apple both positive 0.58%, positive 0.32%, Google positive 0.42%, almost unchanged in Facebook. But only one mega cap stocks in the red yesterday, the tech mega cap stocks, is Amazon down negative 1.22%, and even the laggard Tesla, the underperformer since currently at year to date among the 7 mega cap stocks, has started to show sterling performance as well since the start of this week. Okay, so net overall, it still leads to a rather positive short-term intraday performance on the US stock market based on a softer US 10-year treasury yield that can't break above the 4.5% medium-term resistance level. And also in terms of the market breadth, yeah, even though we start to see the mega cap stocks still continues to contribute a significant portion of the positiveness that is being seen on the S&P 500 and the Nasdaq 100, but the market breadth key market breadth, one of the key market breadth indicators on the S&P and the Nasdaq 100 continues to show signs of improvement as well. So what do I mean by this market breadth indicator? Is looking at the percentage of stocks above the 20-day and the 50-day moving average of the component stocks inside the Nasdaq 100 and the S&P 500. So you look at the Nasdaq 100 over here, the 20-day percentage of Nasdaq 100 stocks above their 20-day moving average continues to hover above the 50% mark. So yesterday it came in at 56.86%, still continues to display a series of higher low, okay, since the lowest point that was made on the 18th of April this year, where it is at 28%. So the number of stocks, component stocks, I would say, in the Nasdaq 100 that is still above their 20-day moving average is still on a healthy level above 50%. And the one that is holding above the 50-day moving average continues to improve very strongly, now at 67%. That means 67% of Nasdaq 100 component stocks are above their respective 50-day moving average. Okay, so indicating to us that both the short-term and the medium-term trend of the Nasdaq 100 is healthy. There is still no showing signs of breadth deterioration in the Nasdaq 100. Okay, now a lot of people are concerned about the S&P 500. Why? Because it's lagging behind. But if you look at the percentage of stocks above the 20-day moving average, it's still hovering below 50%. Yeah, I know it's still below 50%, but the higher low, it starts to flash up a series of higher low since end of May this year. Okay, similar for the percentage of the S&P 500 stocks above the 50-day moving average as well. Okay, now at both are at 45%, 45%. So the percentage of S&P stocks above 20-day moving average is 45%, still below the 50% mark. The percent of S&P 500 stocks above the 50-day moving average is still below 50%, now at 45% mark. But the trend of it, we cannot look at the absolute number. We look at the trend in the past few weeks. It surely signs of improvement. That may start to show a series of higher low, pardon me, not higher high, higher low since end of May. Okay, so indicating to us that the market breadth of the S&P 500 in terms of the percentage of component stocks above their 20-day moving average and above their 50-day moving average are also showing signs of improvement as well. Okay, and one more intermarket dynamics on the S&P 500, which is the US stock market, is by looking at this US net liquidity indicator. So the net liquidity indicator, if you look at this green line over here, is moving in line with the S&P 500 and the Nasdaq 100. All right, so what we could see over here is that previously the net liquidity came down. All right, so the came down in the net liquidity actually coincide with the initial pullback that was seen in 18th of March this year to 15th of April. And the big, we call it corrective, medium-term corrective decline that took shape both on the S&P 500 and the Nasdaq 100 between November 2021 all the way down to December 2022 has been a very clear movement in line with the corrective down move on this green line here, which is the US net liquidity indicator. And look at this over here, the US net liquidity indicator in June over here, it started to show signs of improvement as it starts to tick up higher as well. All right, so net over here is that since we call it late June or the third week of June until now, the net liquidity right now has started to show signs of a improvement. Okay, there's an uptick right now. Okay, so indicating to us that the US net liquidity indicator is slowly moving up as well, and given the fact that the net liquidity indicator has a strong direct correlation with the US stock market as being expressed by the S&P 500 and the Nasdaq 100, that also supports the ongoing medium-term uptrend both on the Nasdaq 100 and the S&P 500, despite the fact that, yes, we do know that the saving government contribution right now is still being highly concentrated on the mega cap technology stocks. But there are still several factors, like I share with you all, the market breadth, and as well as this net liquidity that is still supporting this ongoing medium-term uptrend on both the S&P 500 and the Nasdaq 100. So there's still no signs of exhaustion that supports a multi-week corrective down move on these two indices. So that's from the intermarket perspective. So now, intermarket perspective into FX. All right. So how does this lower? Okay, where is it? Okay, softer 2-year Treasury yield and softer 10-year US Treasury yield impacting on the FX market. So it causes the FX market to be trading still. Okay, where is it? Okay, so my apologies. Okay, to be trapped within a sideways range configuration. So by looking at the US dollar index right now, so what we could see over here is that the dollar index over here in the last since last Friday, it managed to actually trade lower. Why? Because it actually hit the upper limit of this range resistance, which is at 106.37. So this 106.37 also synchronized with the descending trend line that I drew from the high of 3rd of October. And interestingly, so far, yesterday's sell-off and today's early Asia session managed to find support at the lower limit of this range configuration that I highlighted earlier at the start, late last week as well, as also at start of this week at 105.24. Okay, 105.24. So what it means over here is that it's actually confluencing with the 50-day and the 20-day moving average as well. All right. So it seems to us that the dollar is still being trapped within this range, this kind of a short-term range of 106.37 and 105.24. Okay, so at this point in time, do not forget over here is that we also do have some risk event that is taking shape this week. So in fact, today you have the UK election. Later I'll talk more about it. How does it impact the euro sterling pair? And as well, over at the weekend, there's still a potential uptick in the sovereign credit risk in France on the outcome of the second round of the France legislative parliamentary election, where the first round, Le Pen's far-right party is leading the fort, but still not of a major majority. And the second place came in on the far left, and Macron, that is much more business-like and commercialized-like, where is more supportive of EU policies, came in the 3rd place, but not the 2nd place. All right, so something to bear in mind of this credit, because the risk event that is could potentially be supporting this political risk event that could be potentially be supporting the dollar as well, at least in the shorter term basis. Right, something to bear in mind for. Okay, so this is the intermarket dynamics I want to share with you all. So right now, let us take a look at the intraday technical outlook starting from the FX market first. All right, so before we jump straight into the FX market, let me expand my screen so that you guys could see. Okay, good. Okay, so now let us now take a look at how the major dollar pair performed in terms of a 5-day rolling performance basis. Okay, let me the screen allow it to actually load for a while. Okay, so now let me just change the date over here. Okay, so I'm not sure why it's not showing. It's a bit slow. Okay, never mind. Okay, so just I can't change the data because it's it's a bit slow. So just bear in mind that this is a 5-day rolling performance, not as of 2nd of Jan, but as of today. We are speaking right now, 4th of July. Okay, gosh, it's gone. Okay, now we are up. Okay, good. So that I could update the date so everybody is much clearer now. Okay, now where's the text? It's gone again. Okay. Okay, good. So this is the 5-day rolling performance of the dollar against the other major currency as of 4th of July. That means the current date right now. So what you could see over here is that yesterday we see that dollar sell off upon the release of that not so favorable US ISM services number and the ADP employment data that increased the odds of a second interest rate cut in December FOMC meeting that causes the 10-year and the 2-year treasury year to remain soft below their respective resistance level, eventually leading to weakness on dollar against the major currency in terms of the interest rate differential between the US bond US sovereign bond or sovereign note, we call it, against the rest of the world. Okay, the premium reduces, all right, because higher chances of the second interest rate cut to come in the December FOMC meeting that I showed you earlier on the CME Fed Watch 2. But what's interesting over here is that after the sell-off, we see some recovery taking shape, especially against the dollar yen right now that is still leading the pack. That means the dollar is still strongest against the yen. It continues to trade above the dollar index. Also, pretty much strong against the dollar Swiss and the dollar Chinese offshore yuan. Given the fact that the dollar, the Chinese, there are several key economic data that remains weak, especially the Caixin Services PMI that was released earlier this week. And the European currency together with the Aussie dollar continues to actually outperform against the dollar because they're actually trading below the dollar index. Okay, because this $1 equals to how many euro? So what you could see over here is that the euro and the sterling is not showing signs of we call it much recovery after the initial push up from the sell down of the dollar against the euro. So what you could see over here is perhaps a bit of sideways movement on the euro and the Aussie dollar going forward again on an intraday basis. But the dollar continues to help firm against the yen, okay, on a short-term basis. Okay, so with that, let us now jump straight into the short-term intraday technical outlook. Okay, starting from the euro dollar. So the euro dollar yesterday, it broke above the 1077 we call it 790 key short-term resistance level. And what we could see right now over here, it's invalidate yesterday intraday bearish bias on the euro dollar. And what we could see over here is that yesterday price movement actually hit the 61.8 Fibo retracement of the previous down move, means the previous decline from 4th of June high to 26th of June low. So you draw this line here is actually the 61.8 Fibo retracement coinciding with the minor congestion area of 13th of June and 14th of June. So there's some form of price action that's been resisted at the Fibo golden ratio of 61.8 and the graphical resistance coinciding at 1.0815 level. And 1.0815 level was also the next resistance level that we highlight after the breakout of the 1.07 we call it 760 790 level that we highlighted yesterday. So very interestingly over here is that the price action also now trying to actually reintegrate back below the 200-day moving average that is acting as some form of resistance. So there was a spike up yesterday, and right now it tries to reintegrate back below this 200-day moving average as well. So with that, right, I will say that it's a rather mixed element right now. So I will actually flip to a neutrality stance for today for the euro dollar. So neutral between 1.0815 and 1.0770 for now. Okay, so if we start to see a price action breakdown below 1.0770, then we potentially could see short-term intraday weakness on the euro dollar to expose the next near-term support level on the intraday basis for today at 1.0750, which is coincide with the 20-day moving average acting as a support as well, followed by this Tuesday V-shaped recovery, which is at 1.0710 level for the next near-term support level to watch if 1.07710 breaks down on the intraday basis. So on the pound, which is the sterling dollar, so the sterling dollar yesterday, very interestingly, it spiked up above 1.27 figure level, and this spike up, this 1.27 figure level was our short-term intraday bearish bias level to maintain a pullback of the sterling dollar towards this 12650 level, then followed by 12610. But however, price action spike up and invalidate our yesterday's intraday bearish bias. But where it spike up, interestingly, it managed to do some form of a we call it pullback, and this pullback level actually coincided. If you look at the daily time frame chart over here, okay, is in fact the descending trend line that I drew from the high of 13th of July. So this is something like the upper limit of a symmetrical triangle range configuration, medium term, that the sterling dollar is still evolving since the high of 13th of July and the low of 4th of October last year. Very clearly, these are the two symmetrical triangle upper limit and lower limit. And yesterday's price action managed to see a bit of pullback from the upper limit of this symmetrical triangle range configuration that is acting as a resistance at the 1.2770 level, okay, over here. And if we will do the Fibo retracement from this last we call it a sell off from 12th of June all the way down to the this Tuesday intraday low, okay, the 1.2770 also correspond to the golden ratio of 0.618. So there's some form of what I call confluencing factor that is preventing yesterday's push up from breaking above higher the 1.2770 level on the sterling dollar. So with that, I rather have a neutrality stance today on the sterling dollar. So neutral between 1.2770 and yesterday's bullish breakout, that resistance turns into a pullback support level right now at 1.27 figure. We also confluence with the 20-day moving average, I think, as a support level right now as well. So only a breakdown below 1.27 figure level will see at least some form of intraday softness or weakness on a sterling on the intraday basis to expose the next near-term support level also on the intraday basis at 1.2650, then thereafter followed by this Monday's recovery level, the V-shaped push-up low at 1.2620/1.2610 level, which confluence with the former minor swing high of 3rd of May. Okay, so that's for the sterling dollar. So now moving on, next will be the dollar major against the Asia Pacific currency, starting with the dollar yen first. So the dollar yen, still recall yesterday we do have the 16110 as my key short-term pivotal support level. So this 16110 was tested twice during the US session yesterday after the release of that the US ADP employment data and the ISM services PMI data. Notice the long tail that is being formed, the long shadow. That means there is some form of support that is indeed being supported by the 16110 level. That means there are bids coming in to support the price push up, and right during the start of today's Asia session, there was a sell off, but the long tail came again by forming a bullish hammer. So this indeed 16110 is like a magnetic level where price action tested but refused to break down. So this is indeed a pivotal support that we highlighted. So that's what I call pivotal support, a magnetic level where there are what we call volatility that's being formed, but at the end of the day, the bulls managed to survive so far right now. So with that, I cannot validate a bearish bias on the dollar yet, just purely on a technical analysis, integrated technical analysis perspective, because price action are still showing positive element at the 16110 short-term pivotal support level. And right now we start to see the RSI, the hourly RSI starts to form a higher low as well, very close to the oversold region. So with that, we will still use 16110 as my short-term pivotal support level. First resistance to watch will be 16195, which is the minor swing high yesterday before that intraday sell-off took shape. Above 16195 exposes the next resistance at 16240 next. Only an hourly close below 16110 will invalidate today's intraday bearish bias on the dollar yen to see a deeper pullback to expose the next near-term support level on the intraday basis, which is 160.30 followed by 159.90, which is the former swing high area of 24th of June. Now, Aussie dollar. So what's interesting over here is that the Aussie dollar on the daily time frame first now is testing the upper limit of the symmetrical triangle range configuration that is in place since 3rd of February, okay, at around the 67.30 level. Okay, so it tested there and starts to shape a pullback on the intraday basis. So on the Aussie dollar, moving forward on a intraday chart over here. Okay, so what we could see over here on the Aussie dollar at this point in time, it's also pretty much hitting the pivotal the medium term resistance at 6730 before it starts to shape that sell off over here. And what we could see over here at this point in time, it starts to form a hourly bearish doji candlestick formation, okay, at this point in time while we are actually speaking. So with that over here, I will actually still have a bearish bias on the intraday basis, okay, on the intraday basis. Why? Because if you look at the price action on the hourly RSI, it starts to shape a lower high at upon hitting a overbought level yesterday. Okay, so some form of minor bullish exhaustion is being seen on the Aussie dollar pair. So for sure, using 6730, which is the medium term symmetrical triangle with resistance, medium term symmetrical triangle resistance that I show on the daily chart. So as long as 6730 is not surpassed to the upside today, we still have that intraday bearish bias, but with a tighter first support level to watch at 6680, which was yesterday level that was taken out yesterday. That means yesterday's minor range top that was taken out now turns into a pullback support. Only a breakdown below 6680 may expose further intraday weakness towards 6640, which is corresponding to the 20-day moving average as well, and the minor swing low of 2nd of July on the Aussie dollar pair. Only an hourly close above 67.30 will invalidate today's bearish bias and potentially from a medium-term perspective shape a bullish breakout scenario from that symmetrical triangle range configuration. But in first step, the next intermediate resistance to watch will be at 67.80, followed by 68.25, 68.40, which is the 1.618 Fibo extension, and as well as conferencing with the congestion area over here from 29th of December, okay, to 2nd of Jan this year. Okay, so that's for the Aussie dollar, and we also sum up the short-term intraday technical outlook on the major FX pair. So with that, now let us move forward to the short-term intraday technical outlook on the major stock indices. All right, so for the major stock indices over here, what we could see over here is the starting with the Japan 225 first. So the Japan 225 yesterday, we do highlight two resistance level to watch. Bullish bias 40.76 has been made, followed by 41,000 / 41,055. All right, so with that, it seems to us that this movement over here is a bit overstretched, as we could see the price action has started to leave the 20-day moving average by a fair distance of it. It's getting more and more steeper above the 20-day moving average. And what we could see over here also, there is a bearish divergence that has been formed on the hourly RSI momentum indicator at the overbought level. Right, so what we could see over here at this point in time is that I'll be using 41,000 slash 41,055 as my short-term pivotal resistance level for today, looking for at least a short-term intraday bearish bias for a pullback to take shape, given the fact that it's a bit over extreme in terms of this movement, as price action has started to lift away the 20-day moving average by a fair bit, and also the bearish divergence that is being flashed out on the hourly RSI. So first support level to watch on an intraday basis for this pullback to unfold will be the minor swing low of yesterday's at 40,500. A breakdown below 40,500 exposes the next near-term support on an intraday basis at 40,230. All right, only an hourly close above 41,055 will invalidate this potential intraday bearish bias for that pullback to take shape on the Japan 225 or the Nikkei 225 to see a further impulsive up move to retest the all-time high at 41,175. Above it exposes the next resistance level at 41,460, 41,500, which is being defined by a cluster of Fibo extension level at 1.236 from the low of 17th of June, and as well as 1.382, okay, 1.382 taken from the low of 19th of April. All right, so that's for the Japan 225. Now moving on will be the Hong Kong 33. All right, so from the Hong Kong 33, price action starts to push up, and right now we are doing that pullback away from this bullish breakout of this, what I call that, bullish descending wedge configuration. So the pullback of this descending wedge configuration lies at 17,900. So I'll be using 17,900 as a support level for today. So this will be my short-term tighten short-term pivotal support level to maintain that short-term intraday bullish bias on the Hong Kong 33 or the Hang Seng Index. The first resistance to watch no change will be at 18,240. Only above 18,240 may expose the next near-term resistance, which is the minor swing high of 19th of June at and 20th of June at 18,450. Only hourly close below 17,900 will invalidate this previous prior minor bullish breakout to see another round of choppy corrective push down to retest last Friday's swing low at 17,600 level. Below it exposes 17,460 next, which is also the golden ratio of that Fibo retracement taken from the low, the previous push up of 19th of April to 17th of May. Okay, so that's for the Hong Kong 33. Now moving on will be the German DAX. Okay, so the German DAX yesterday managed to do a nasty push up above 18,370, which is our former short-term pivotal resistance that we have yesterday. But what you could see over here is now retesting that 50-day moving average that previously fails to break out on Monday. All right, on Monday it fails to break out, and now it's retesting this level again, slightly below 18,520, which is the descending trend line that still kept previous bulls rally on the 28th of May and the 6th of June from inching up higher. Then now is acting as a resistance as well as 18,520 level, which is also very close to the golden ratio of 18,550 that I drew from the high from the of 16th of May all the way down to the 14th of June over here. So with that, it's rather mixed right now, and also given that the RSI is now back at the extreme overbought level as well. So neutral between 18,520 for the German DAX for today and the 18,300 level, which is the 20-day moving average, now acting as a support level given yesterday's short push up. So only a hourly close below 18,300 will reinstate the intraday bearish bias on the German DAX to see a retest on the 18,085 level, which was this Tuesday minor swing low area. All right, but however, if we start to see a breakout above 18,520, then potentially we could start to see a medium-term bullish breakout scenario unfolding on the German DAX. That means a start of a new impulsive up move, with the first resistance to take note of on the intraday basis will be at 18,640, followed by 18,750, which is the minor swing high of 6th of June. Okay, so that's for the German DAX or the German 30. Moving on, next will be the major US stock indices, starting with the Dow Jones Industrial Average or the Wall Street 30. So the Wall Street 30 going to underperform yesterday, still going to trap below 39,600, but managed to find support at the 39,090, 38,945 that we pre-highlighted earlier this week. All right, so that was being supported on Tuesday. So I don't put it so tight. So the first support level that you could watch for today will be this former minor swing high, not the pullback support, slightly above 39,000 at 39,200 level. Okay, but it's in the middle of this range. Okay, this range. So the lower limit of the range still no change at 39,090 / 38,945 level. We also confluence with the rising 20-day and the 50-day moving average. So as long as this pivotal support zone holds, we'll still maintain that short-term intraday bullish bias on the US Wall Street 30. First resistance to watch 39,600. A breakout above it exposes 39,790 next. All right, only hourly close below 38,945 will invalidate today's intraday bullish bias on the US Wall Street 30 to see the index floating down towards 38,730. Then below it exposes this ascending trend line at 38,560 / 38,420 level. Okay, so don't forget, before I jump out to the Nasdaq 100, I need to inform you all that the liquidity on the US stock market will be lesser today. Why? Because today is US Independence Day, 4th of July. So the cash US stock market will be closed for today during the opening of the US session. Okay, something to take note of. And also the Nasdaq 100 over here. So the Nasdaq 100 continued to push up and almost hit the first resistance at 20,260 that we highlighted earlier. So with that, we will have a tightened key short-term pivotal support for today. And given the fact that the RSI now is at the overbought level, but no signs of a bullish exhaustion because there's no bearish divergence that's being formed, because the RSI continues to move in line with the higher high that is being seen on the price section of the Nasdaq 100 as well. All right, higher high. So potentially there could be a pullback because of an extreme overbought condition. So first pullback support level to watch over here will be this level here, the former minor swing high, now turns the pullback support at 20,060. But I'll be still using this congestion area here, which is much more significant. And as well, if you do the Fibo retracement of this last push up, it also confluence with the 50% Fibo retracement. All right, so as long as this pullback didn't surpass below 19,920, we'll still maintain that short-term intraday bullish outlook on the Nasdaq 100. Next resistance level to watch will be at 20,360, followed by 20,490, which is the 1.382 and the 1.618 Fibo extension taken from the last recent low of 25th of June. Only hourly close below 19,920 will invalidate today's intraday bearish bias to see it floating down to retest 19,620, 19,507, which is corresponding to the lower limit to the 20-day moving average, and as well as the minor swing low of 25th of June and 24th of June. And like I said again, today's session, there'll be a lower liquidity environment on the Nasdaq 100 as well. Why? Because today is 4th of July, US Independence Day, public holiday for the cash US stock market. Okay, so before let's actually sum up the short-term intraday technical outlook on the major stock indices globally. All right, so now let us take a look at the commodities market. So on the commodities market, starting with this gold XAU/USD. So for spot gold XAU/USD managed to break out our neutrality zone yesterday, the upper limit at 2,344, and also clearly breaking up above this minor descending channel resistance that I drew from the all-time high of 20th of March. So with that, there's some kind of positive bullish bias that's taking shape. And what's interesting, price now starts to do a bit of congestion or sideways range. Upon hitting the next resistance, which is the minor swing high area of 20th of June and 21st of June at 2,365. And also the RSI now has started to shape down lower high after hitting the overbought level. Okay, so now intending to hit to actually do that retracement to work out from its overbought zone that was hit previously. So with that, I will use 2000. Means there will be a form of a pullback, of a minor pullback taking shape. So with that, potential pullback support level to watch will be at 2335. Why? Because this level also coincide with the former minor swing high area, minor range top of 28th of June and 2nd of June, and as well correspond very closely to the 50-day moving average, and as well as this pullback line of this former descending channel resistance now turns into a pullback support level. So this is indeed a pivotal support level. So for the bulls to actually hold in any form of pullback, this level, it must start to bounce up, right? So that's why this gives me defined as a pivotal support. So 2335 short-term pivotal support, flip to a short-term intraday bullish bias on XAU/USD gold. A break up above 2365, that's my first resistance, exposes the next resistance level at 2386, which is the swing high area of 7th of June. All right. And only an hourly close below 2035, that means a breakdown below this level or reintegration back below this level, indicate to us yesterday's push up was a failure bullish breakout. Then we will start to see, we will invalidate today's intraday bullish bias for sure to see it floating down to retest 2318, followed by 2296 level on gold. All right, so now moving on, lastly will be the West Texas crude oil over here. So for the West Texas crude oil, on an hourly basis, no change. What we could see over here is that price action continues to form a series of higher low again. So yesterday there was a sell-off, but managed to bounce off from this minor ascending channel support level that I drew from the low of 4th of June. So no change, still using the 8190 level, slightly above yesterday's low, which is at 8269. So it's 8269. So still using 8190. So as long as price action managed to hold above 8190 in any form of a pullback today, we will still maintain that short-term intraday bullish bias on West Texas oil. First resistance to watch 84.40, above it exposes 85.05, and a breakout above 85.05 potentially sees the next psychological level of 86, which is the minor swing high area of 16th of April and 19th of April. All right, so before we go, I want to highlight one more extra thing that could actually very interesting to see will be the ex-post result of today's snap UK election. Okay, that will be the euro pound, the euro sterling. So we know that the euro sterling on a weekly chart basis, previously it actually managed to came down, it's going to actually trade in a very sideways range configuration, but this is the weekly chart. But it seems to us that it's now potentially inching downwards to retest its 2-year low area at around this 82.50 level mark. Okay, previously it hit a low of 83.97 before bouncing back up, and right now there is some form of weakness coming back right below the pivotal resistance level at 86.20. So this is a medium term one, a higher time frame, and also a downward sloping 200-day moving average. So on a weekly chart, we still see some form of weakness of the euro sterling dollar. All right, so that means sterling strength, okay, ahead of this outcome of the UK snap election that is held today. So on an intraday basis, so if you look at intraday basis, that means I can't look at a weekly chart. I'll be flipping on to the hourly chart. So hourly chart over here, what we could see is that rebound, that previous minor rebound from the low of 14th of June managed to store at the 50-day moving average that is acting as a resistance at 84.04. So if you flip to the daily chart of 84.04, it also coincides with the former swing low area of 10th of July all the way down to 28th of May, bearish breakdown, and this form a pullback. All right, and the pullback over here, the pullback resistance, managed to see a series of negative price reaction after a bearish candle splitting top is formed. All right, on 1st of July, which is this Monday. So then overall, we see some form of bearish bias on the euro sterling ahead of this outcome of the UK election that is being held today. So using the 84.04 as my short-term pivotal resistance level, a breakdown below this intermediate support or a very near-term micro support at 84.57 may expose further weakness on the euro sterling on the intraday basis at 84.36, followed by 84 figure, which is the minor swing low of 14th of June. All right, only an hourly close above 84.04 will invalidate this potential intraday bearish bias on the euro sterling to see it squeezing up towards the next near-term resistance at 85.30, followed by 85.60 next. Okay, so that's something special to take note of, given the risk event that is taking shape today, which is the UK election on the euro sterling pair that I highlight to you. Okay, so with that, that sum up the short-term intraday technical outlook on the cross asset classes. With one more additional to share today will be the euro sterling pair. And with that, let's take look at the calendar. So bear in mind that I still mentioned today the US will be closed for a public holiday due to the 4th of July Independence Day celebration. So on the US session should be very quiet, no key data releases. So ahead of today, let us see is there any data to take note of during the European session. So during the European session, we do have a key data to take note of will be the Switzerland inflation rate that is out later at 2:30 p.m. Singapore time for those who are looking at the Swiss FX pair. Okay, something to take note of. Then thereafter will be a rather quiet session. Okay, nothing to take note of except for the outcome of the UK general election. All right, so with that, thank you for your time. This is Kelvin here signing off. I wish you all a great day ahead, and also a heads up, tomorrow I'll be away, so there will be no daily dose for tomorrow, 5th of July, and daily dose will resume again on the 8th of July. So thank you so much, and I wish you all a great day ahead, and as well as a restful weekend, and we shall speak again on next Monday, 8th of July. Thank you.